Investors, welcome back to the channel. My name is Ari Gutman, and of course, every single week I am delivering through on economic insights that you need to know, and of course, brand new dividend stock ideas. Every now and then I have the opportunity to have a guest on with me, and today we have none other than Ryne Williams. I am 100% sure you have landed on his channel before. He is blowing up on YouTube as a dividend investor. I sure as heck got a lot of dividend stock ideas on his channel. If you haven't checked it out already, you gotta head there immediately after this video. Without further ado, Ryne, welcome to the channel. And I want to start off with the very first question here. Of course, it's the hot seat question. Are you ready for it?
Absolutely. I was born ready, man.
Okay. Let's go. I want to know right off the bat, Ryne, what is your net worth, the total value of your dividend portfolio?
So I have two different portfolios, main just taxable brokerage account and a Roth IRA. The two combined, it's nothing crazy, but I just crossed the $50,000 mark. Woo! Maybe within the last month. I mean, the market's had a really nice run up, so that kind of pushed me over the edge. But yeah, that's about where I'm sitting right now.
There we go. And we'll give it to you too, because in the last week or so, the market came down by like 2 to 3%. So you tipped over 2,000 and came back down. You'll go back over.
Oh, dude, I'm still, fortunately, I'm still over. So you gotta give it to me and let me keep it.
You're still over, right? Over 50,000 in the dividend investment portfolio. The next big question I have for you, and it's actually one of my favorite questions to ask any and all investors, is what's your story? What's your background? I'll give it to you this way. What is the Ryne Williams story and why dividend investing?
It's a great question, man. And bear with me as I try and explain this, because I tend to get a little long-winded. But I mean, really, investing, I got my first exposure to it when I was maybe 11, 12, 13 years old. And at the time, my parents made custodian accounts for myself and all of my siblings. And then from that point on, 11, 12, however old I was, every Christmas, every birthday, every Arbor Day, whenever there was a gift that needed to be given, it wasn't Xbox. I wasn't getting Halo or Grand Theft Auto or anything like that. I was getting money for my Charles Schwab account. And at the time, as I'm sure you can imagine, being that young and getting money for a stock portfolio, it's not something you really get excited about, right? It's like, you know, I'd get that and be like, okay, great. Thanks, Dad. I don't know what I'm going to, I don't know who this Chuck guy is, and I don't know what I'm going to do with this, but thanks. And my parents would always, you know, it became kind of a running joke in the family. And my parents would always say, you know, you're going to think of someday, you're going to be glad that you have this someday. And sure enough, I was maybe 25, 26, somewhere in there. And then it started to click. I don't know exactly what it was, but I finally understood, number one, the importance of investing and the fact that everyone needs to do it. And as Warren Buffett says, if you don't find a way to make money in your sleep, you know, you're going to work until you die, AKA, in other words, you won't be able to retire. So it's something that everyone has to do. And suddenly it hit me. And from that point on, I just decided to start investing. So I just turned 30. So I've been at it for maybe, I've been at it. Thank you, man. I've been at it seriously for about maybe 3.5 years at this point, between 3.5, 4 years, actually, somewhere in there. And from that point on, I just started contributing little by little into the portfolio that I had. I also had a little Robinhood portfolio on the side, and eventually I combined the two into one, which was great. But then as far as dividend investing, you know, when I first got interested in this stuff, when it finally hit me that this was something that I needed to be doing, the first place I turn to is, as many of us do, is YouTube. If you want to learn anything, that's where you go these days. And so I soaked up everything I could about investing in general, stock investing. And I found channels like Graham Stephan. I mean, the obvious ones, right? Sure. Graham Stephan, Andre Jick. Who else am I missing? Jeremy from Financial Education, The Dream Green Show, my man Russ over at Dapper Dividends, my man Darth, Gen X Dividend Investor. I found all of these, PPC Ian, I can't forget Ian. But all these really, JJ Buckner, here's another one. The list goes on and on. But I found all these great channels. And the more that I watched, especially the more that I watched these dividend investing channels, the more it started to resonate with me. And the more that I think I liked the idea that at some point, or I guess I like the idea that I could live off the cash flow from those dividends. And at some point I wouldn't have to sell the the shares of stock that I'd spent so many years accumulating. I wouldn't have to sell off those assets to be able to benefit from them. And so that really stood out to me. That really fit my temperament. And from that point on, I don't know, at some point I just decided to go all in on dividend investing. And this was pretty on into my, I guess, investing journey. And since then, I've been a diehard dividend investor. And, that's kind of brought me to where we're at now.
So I got to ask, because I mean, you had your childhood, which is like you had these accounts now that were open for you as a child. Did you have any? We're gonna get raw and like open here. Did you have any like resentful moments like at your parents? It's like, hey, you're a kid, like you want to buy the Xbox or you want to buy, whatever hot game was out at that point in time, or were you more aligned with your parents? Like, oh no, this is for my future. Because I feel like today, right? I can't imagine a world, especially today, where everyone's so connected to cell phones and technology that they're just putting money aside. If you go back,
Yeah.
young Ryne, like when you were a child, did you feel like that wasn't the right move? Or did you trust fully your parents there that like, no, they're right here. They have to be.
Yeah. I think I felt pretty indifferent about it.
Yeah.
I'm sure what I would have rather have gotten other presents, and I did. It wasn't just that and only that,
Yeah.
So don't get me wrong too. I'm certainly did not have a deprived childhood. I had a pretty good childhood and I love my parents.
A born
And
dividend investor, man.
yeah. And my parents are fortunately like they were always very into this stuff. And so I can see why they thought that would be a good, important gift. And yeah, I think I was pretty indifferent to it. Definitely no resentment. And certainly in hindsight, like I'm grateful. I'm grateful that they did that. And I'm grateful that they made me, I don't know, I guess it was like short-term wanting something else, sacrificed for the betterment of the long term. And today, like I'm all about it. A lot of the things that I'm interested in, a lot of the things I do are based around that. Outside of investing, I'm really big into lifting weights and fitness. And that's certainly a trade-off of short-term comfort for long-term benefit. And the same is true with investing. So no resentment, no negative feelings. And I'm so happy that I caught the bug. That's the best way to put it.
I'll go now on the flip side of this coin. So I know when I was growing up, right, I would always go to, the toy store or wherever with my father. And one thing that he always asked, which I loved to this day, and it's something for me that, one day when I have kids, I'll always ask them was, do you really need, this game or this, toy or stuffed animal, or do you just want it? And I always think about that question, even now today. Again, I didn't have any, deprived childhood, but it always had me thinking, do I really need it? And, I wasn't necessarily investing. I think you beat me to the investing game, to be honest. I had a lot of fear growing up in my teens to even invest and get in the money market, right? Or just have a high yield savings account. I just didn't understand a lot of that. But,
Yeah.
I think back, I was a super saver. And I did really well in saving. And I think a lot of that, is attributed to my father and sharing, how to prospectively look at, life and time and valuing money and time. Do you have any lessons like that from your parents? Because they sound really like parents who set you up financially with an amazing outlook on finance. What would you say were like the one or two lessons that you've really taken away from your parents?
That's certainly one of them. And obviously, like I said, that one kind of hit me, I don't want to say later in life, but later in my life. Um, one thing that I've always been grateful for when it comes to my parents is they just let me, they support me in anything I do. And as a parent, I think that's probably a difficult thing at times, but it's also a pretty important thing. Like if I didn't have that support, I probably, may not have started a channel, may not be doing what I'm doing now, may not have had the freedom to make mistakes that I've made along the way. And so that's certainly been one takeaway from, as I've gotten older, just kind of being reflective. That's certainly one thing that I'll carry into being a parent someday, is just supporting, my son or daughter, or the plural version, and whatever it is they do, and kind of let them be whoever it is they think they are and figure that out. But and there's obviously like I'm not going to let them do anything too crazy.
Yeah. No growth
But
investing.
yeah, but that's been one big thing, just being able to come into my own and figure it out as I go, and having the freedom, I guess, to do that.
I love it. I love it. And so at 25, then you really kind of had this deciding investment factor there that you'd be this dividend investor. What was it about, financial freedom and passive income that really hooked you? Because I feel like, and I say this quite often, right? There's so many of us who are out there as investors that can get lured into this, meme stock or growth investing. I want to get rich by Tuesday. But here you are at 25 years old, 25-year-old Ryne saying, I'm going to take the dividend investment route. And that's the route I want to use for financial freedom. What hooked you on it?
Dude, I think I'm just a glutton for punishment, really. No, all jokes aside, man. I mean, just at that time, having 7 or 8 years of experience being into health and fitness, which once again is a long-term thing. I think I understood delayed gratification pretty well. And so I understood pretty well that anything worth having, anything worthwhile does not come fast. It doesn't come easy, and it doesn't always feel good. And so this dividend investing thing, which some could argue is maybe the slowest way to build wealth or financial freedom, I was fine with that. I was fine with sacrificing quick gains and money that I could spend today for the betterment of my future, because thanks to so many different dividend calculators out there and compound interest calculators, you can literally crunch the numbers and see, or guesstimate, I guess, what things might look like 15, 20, 30 years down the road. And it's not an easy thing to think that far ahead, but when you look at those numbers and just see how powerful this thing could be, if you just stay consistent with it and be patient, I think that was one of the things that made me okay with going down this road. But I think in there you asked, like, there was another question in there, something about why investing, right? You might have to remind me what it was, but there was something in there that I also wanted to address.
Why, when it comes to investing in and of itself, right? Like, you chose dividend investing, passive income investing versus growth. And growth, a lot of people, I mean, you probably get these comments in your channel as well, but a lot of people would ask, why not just invest right in growth stocks? And, a lot of them can 2, 3, 4, 5x. Meanwhile, you're just dividend investing. So yeah, it's delayed gratification, but is there something in there, like, for you that feels like a security blanket, or, it's just safer? Like, what?
Yeah. They say dividends are never guaranteed, right? Obviously, a company could cut a dividend at any given time, but if there's a dividend policy in place, I think that's undeniably more certain than any sort of movement in share price. And that was something, at least that's been my take on it throughout this whole investing thing. And once again, I said this earlier, but I also like the idea. So there was that, just getting that cash flow, which I figured was more certain than gains in share price. But like I said earlier, someday not having to sell those shares and being able to have this portfolio live long after I did, in the hopes that it could better the lives of those that remained after me and came after me. And so I think it was those couple of things that really gravitated me towards, I don't want to say an income style of investing, because I do appreciate share price appreciation,
Sure.
but going more so the dividend route versus something that was going to offer hyper share price appreciation, and there was a lack of dividends. Does that kind of make sense?
Sure. Now, I've had the honor of having quite a few different investors, dividend investors specifically, here on the channel, talking about, their journey. A lot of us, even when I watch other channels, have had a lot of mistakes that were made. And I'm going to first ask, right, what you think. And you said about 3-4 years worth of dividend investing of a journey you've been on so far. In the last 3 to 4 years, what's been your biggest mistake that you think you've made when it comes to dividend investing?
Man, my biggest mistake.
You could have maybe 2 or 3 if
yeah, I mean,
a couple.
That's a really tough question. I would say a pretty obvious mistake that I think a lot of us go through when we start is just buying stocks without really knowing how to look at stocks.
Mm.
Um, and one could maybe make the argument that I made a mistake not just buying into ETFs when first starting out and first learning the ropes, because I pretty much went all in with individual stocks. And I don't know that there really is a right or a wrong way. I think you can kind of learn as you go. And fortunately, when you start, you're starting small. So any losses, it's not going to completely wreck you for the long run, which
Sure.
is why it's kind of tough for me to come up with any sort of mistakes. I mean, if I did have some, it would be that just making decisions that were based on bad information or any lack of information or understanding about how all of this stuff worked. But outside of that, man, I've had a pretty, I don't know, I feel pretty good about everything that I've done from the start up until now. I've had some really good wins. I've had a couple of losses. I just sold out of one of my positions for quite a loss, but that was something that happened as a result of not knowing things when I first started. And so, yeah, I've made some mistakes along the way and
Was
I've had
that
some losses,
3M?
but yeah, it was.
I commented on that
Yeah.
video. I have to
Yeah.
say, I was happy to see that one out of your portfolio. I've been waiting for that moment.
Well, good, man. I served to please, so I'm glad you're happy.
Now, I want to ask, so a lot of, again, just from interviewing other dividend investors, everyone has, right, their own strategies that they're putting into dividend investing. Now, for me, and I started off very similarly to you, where it's like load up on dividend stocks. Like the more the merrier. I want them all. And I think for me, when I started off, mainly it was in 2020. I had like, a shopping spree into dividend stocks and loading up the portfolio. And I know you and I have actually spoken about this on different accounts, but I've shared that I basically am now in this process of trimming because my portfolio just got too big, too fast. And a lot of the positions I feel like I only had, maybe sometimes 3 shares of a position, don't consider it worth it to, 25 cents worth of a dividend or whatever was coming in. So trimming out of, a lot of different positions, reallocating the capital elsewhere, and really growing what I'd like to say quality positions. So big positions, right, with quality stocks. Do you think that there is a, perfect number or magical number for a dividend investor? Because for me, I'm finding at least my sweet spot is like I can only really keep tabs on 10 to 12 stocks. And 2 of
Mhm.
them, honestly, within my portfolio, ETFs. So that eliminates 2. Now I got 10 that I'm really focused on. And for me, I'm able to keep tabs on them. I watch them. I invest in them, doubling down on them when they're down, dollar cost averaging in them when they're not. But I want to know from your standpoint and your years here of experience as a dividend investor, what's your magic number? How big is your portfolio, by the way, in terms of holdings count?
I think after the sale of 3M, just in my taxable brokerage account, I think I have 22 different
Okay.
holdings. And then in my Roth IRA, I've just got a few ETFs. So kind of a balance there.
And before you sold out of 3M, did you that was like one of the only sales that you had, or did you have a much bigger portfolio before?
No, that was more or less it. I can't remember I think the last stock I sold was Lockheed Martin. I locked in a gain on that and reinvested into 3M, which has done quite, or not 3M, excuse me, Snap-on, which has done quite well for me. But I don't sell stocks all too often at all.
Sure. So, okay, 22 stocks then, 22, 23, if you want to consider 3M.
Yeah.
What would you say to investors out there who have 50, 60, 70? Because, like, as you know, I had Jason Fieber on before. I love Jason,
Yeah.
and his strategy works very well for him. I mean, Mr. Free at 33, it's right there in the name. And honestly, I heard this from somebody else out there on YouTube that essentially the scoreboard is your brokerage account. So if it works for you and that's your strategy, amazing. But what would you say to a newer dividend investor who's asking that question of, well, how many dividend stocks should I have within my dividend portfolio? I mean, Ari's saying 10, right? Ryne's at 22, Jason Fieber's at over 100. What would you say or guide someone as a newer dividend investor?
Gosh, man, this is such a tough question to answer. And it's one that gets, as you know, Ari, it gets asked all the time. What's one of the most common questions I get, how many stocks should I have in my portfolio? And it depends on the answer depends on a couple things or a few things. Number one is what you said. How many do you think you can keep track of? And that's something that's going to be trial and error. You're going to kind of figure that out as you go. You'll be able to find your sweet spot just in terms of how much you can mentally manage. You'll figure that out along the way. So that will certainly be an indicator that you'll want to try and pay attention to and listen to. Another thing that I think can help you determine how many stocks you should have is what kind of companies are you investing in? I think if you are investing in businesses that are more mature and their cash flows are more stable, and there's some more consistency there, I think you can get away with holding less companies and taking bigger positions, kind of like you are. But on the other hand, if you are investing in more speculative companies or funds, maybe even funds that pay variable dividends, if we look at like a TSLY or a JEPI, or some others like that, ones whose cash flows or the cash flow they're able to provide you as a shareholder, if you're going to have more of those in your portfolio or some of those, then I think it does make sense to be a little bit more diversified because those aren't as certain. And this is still something I'm thinking through as well. Like I said, this is a very commonly asked question, and it's been a hard one for me to answer because on one hand, I want to say, I don't know, because it depends on you as the investor and just chalk it up to that, which in part it does. But there's so many different variables to consider when it comes to this. But in general, for a brand new investor, someone who's just starting out from scratch, maybe looking to buy the first few stocks in their portfolio, I think a really well-rounded approach is to do one of two things, I think, actually. There's so many different schools of thought on this too, and I'm probably going to get some people who don't agree in the comments. But on one hand, just buy an ETF, buy one ETF, maybe two max. Go SCHD or SCHD VU. That's a really solid combo. Maybe just start there to get your feet wet. If you really want to, if you really have the itch to buy some individual companies, maybe you're a big Starbucks drinker, maybe you shop at Target a lot, maybe you get all your gas at Chevron, whatever it is, maybe there's some individual companies you want to support and be an owner of, then maybe, add a few of those to your portfolio, 3, 5. I think that's a pretty good place to start. Couple of ETFs, couple individual picks. That's a pretty good way to get the best of both worlds. But on the other hand, and this is kind of what I did, and it sounds like what a lot of other people have done as well, is if you're just like, I'm going to go gung-ho on all these individual stocks. I'm watching Ari, I'm watching Ryne, I'm watching Russ, I'm watching Darth, I'm watching the diplomats, I'm watching all these guys talk about all these different stocks. I'm going to own them all. Okay, maybe you could go that route too. I think if you did, you'd be fine. But I think in doing so, you'll end up trimming a lot of those positions over time, which may not actually be a bad thing, because if you're getting rid of some of the weeds in your portfolio, some of the I don't know, holdings you've decided you shouldn't have, then I also think that means that you've learned something. And so going the opposite route, just going all individual stocks and maybe loading up on a lot of those, that might motivate you to learn more about this stuff because you're not as reliant. You don't have the ETFs as some of that safety net. So it's tough to say, man, and this is where it becomes a tough question to answer because there's so many different ways to skin the cat, as I always say. And you'll figure out your sweet spot and you'll figure out what makes sense for you and what feels good for you as you go. But I'm just going to leave it there because I'll go off on another tangent.
No, look, it's so true. When I first started out investing, I wasn't immediately jumping into dividend stocks. I will shout out here Andre Jick for really inspiring me, and Jason Fieber for inspiring me down this path of dividend investing. I loved, I think it was like every week or whatever it was, they would jump on and share how much, dividend income they were making this week or this month. And it was exciting. However, at that point, this is maybe 5-6 years ago, even, longer, 7-8 years ago, just VTI. I was pouring money into VTI, dollar cost averaging in. That's where I put my money. And I built what I think is a very solid foundation off of VTI, which made me very comfortable then to start with the individual stocks thereafter. But to your point, now I'm thinking about, maybe I need another foundational block of SCHD. I haven't committed yet to SCHD, to adding it to my portfolio. Still VTI is down there at the foundation. I think it will for always be. And then it builds. Apple is there after that. Johnson & Johnson's after that. I'd love to know. So, you built your portfolio off of ETFs to start, I think you said?
No, I went all individual stocks.
All individual. And then you started, when did you start adding ETFs? And would you say that someone should start, you just said someone should start really with ETFs, like 2 ETFs. Would
Yeah,
you
I think
think someone
that's
should start with a dividend and growth ETF or 2 dividend ETFs? Or what would be the Ryne formula there?
I would say if you're going to go the ETF route, I think SCHD plus VU, you could
Okay.
even do SCHD plus VTI, is a really good mix. Really good mix of funds that'll give you some growth, and also some dividends, like current cash flow, as well as solid dividend growth. So I think that's a pretty hard combo to beat, something like that.
Sure.
And if one was to go the ETF route, I think that would be a pretty solid spread. And if you wanted to just narrow it down to one ETF and not do two, keep it really simple, then I think VU, I think VTI, those are two great ones to have. Unless you know for certain that you want to go, the dividend route, then maybe consider SCHD, which still has over 100 different companies. It's still a pretty diverse fund, but certainly not as diversified as VTI or VU. So, you one of those three, I guess, is
I
probably
get
the
some on a
short answer.
quarterly basis. I get some magic from VTI. It does show out at right now. I think it's at a 1.5% dividend yield,
Yeah.
if I'm not mistaken, something around that number. But you do get, depending on again how big your position is, a hefty dividend that will come in on a quarterly basis. And to that end, now that I've been trimming my portfolio, what I've seen, which is like my last video, my last dividend income video, I think like $65 or something came in. Now, before I started trimming, I was way closer to about $100 per month. Now I have trimmed. Now I'm on the quarterly basis plan, right? And it's like now I'm getting some months where I'm at $60, $65, $70. And it's almost like a bummer, but I know the quarterly paycheck is coming in eventually. So
Right.
I do also, from time to time, hear dividend investors saying, well, it's better to have income in your pocket right now to invest now. So get all the monthly paying dividend stocks, and you're going to want all that monthly dividend income. What's your stand on that? Monthly dividend income, quarterly, does it matter?
No, dude, it doesn't matter. And if you go use one of the compound interest calculators, the dividend calculators that I was kind of talking about earlier, Market Beat has a really good one. The dividendtracker.com has a really good one. If you use something like that and just all variables the same, change the distributions from monthly to quarterly, you'll find that over the long term, over a 20 or 30-year period, the difference between the two is negligible. It really doesn't make a substantial difference at all in your portfolio, which is why I think it's so important to not get hung up on monthly dividend payers or monthly dividend payers over quarterly dividend payers, thinking that they are a better investment or you'll make more money just because it pays a dividend every single month. That's just not how it works. The numbers don't show that. I actually just made a video talking about the best and worst monthly payers. If you guys do want to see some examples of some really bad monthly payers, or companies that are bad despite their monthly payments. So I wouldn't get hung up on the monthly versus quarterly thing. All that matters, I think, is how your annual dividend income is growing and over time. And I actually was going to ask you about that. So Ari, as you've been trimming your portfolio, how has that affected your annual income? Because you mentioned that on a monthly basis, sometimes those numbers will be a bit lower than they were before. But does that even out on a quarterly basis or an annual basis? Are things more or less pretty similar with less positions as far as your annual income goes?
Yeah, it's a great question. First of all, I've realized that quality matters. Yeah, like
Yeah.
building a sound quality position, focus on it, grow it, because I really do. And I ran with this Bill Ackman approach in 2021, maybe, where Bill Ackman was interviewed and he said at any given time, there's really only 2 to 3 good, high quality investments out there. So focus on them and then try to find the quality, again, more quality that's out there, but focus. I started doing that. And what I found was, first of all, for me, there's no difference on an annual basis. On a monthly basis, there is, because there's a bit of me, if I'm really being honest, that like it's hard sometimes, I feel like, to make a dividend income video. And maybe you've had this before.
Yeah.
Like, You have to be like, and investors, this month I brought in $65 of dividend income. And it's like,
Yeah.
that's it. So I think on like an ego front, it can get to me, but I'm really grateful that you shared what you just shared, because it's so true. If you're taking into consideration that your brokerage account is your scoreboard, and at the end of the year, on an annual basis, you're evening out, then does it matter? And I think oftentimes too, when we see all of us dividend investors with our dividend trackers, what are we making on a month-to-month basis? You always want to see it, double the last month or the previous month or whatever it may have been. But sometimes it's just not realistic depending on your investments. And I'd much rather, for me, be invested into, again, what I think are high quality companies that I really don't have to worry about. I know that the dividends are safe. I know that they're there. Take a good old Johnson and Johnson, right? Like, it's just going to be there. And I feel like if I'm tripped up on monthly dividend income, that's that get rich by Tuesday mindset that I'm very much against.
Yeah.
But
yeah. And I will say, oh, go ahead. I'm sorry, man. I didn't mean to cut you off. I was just going to say, as time goes on and I learn more about this investing stuff, which is a lifelong process, by the way. You're always a student of the game. That's one of the fun and challenging aspects to doing this. But as time goes on and I learn more and about investing and about myself as an investor, I've started to come around more to your way of thinking, and really just wanting to not be as unnecessarily spread out as maybe I have been. And so being able to focus on less positions, there's a benefit to that. But you don't know what those quality positions are until you know what to look for. And so that's, for a lot of beginner investors, that's probably the hardest thing, which is why, if you are going to go the individual stock route when first starting out, yeah, I mean, shoot from the hip. I mean, cast a wide net maybe, and then just from trial and error, you'll learn what to get rid of and what to hold on to. And that can be a slow but important process. But like I said, as time goes on, I'm starting to figure out what that actually looks like for me and my portfolio, hence the sale in 3M, and probably the sale of maybe some other companies at some point down the road too.
Or to be revealed. Stay tuned on Ryne Williams' channel. See what's coming out.
Exactly.
Yeah.
Yeah.
I want to ask, so when it comes to your dividend investment portfolio, what positions do you have any non-dividend paying stocks in there? You get that off the bat there.
Yeah, no, outside of just some of the stocks that are in the ETFs I own, no.
Okay. So what are the top 3 positions in your portfolio right now, aside from the ETFs? Because I'm sure you probably built a foundation with some of them.
So top 3 positions, Procter & Gamble is my biggest position. Starbucks is my second biggest position. And I believe Johnson & Johnson is my third biggest position. Nothing too crazy. I knew you'd be happy about that one. Yeah.
I love Johnson & Johnson more than any other company. I think I've taken so much heat over the years for preaching J&J, J&J, J&J. And people are like, whether it's guys like, you, Darth, anybody else out there sharing like, oh, all right, Johnson & Johnson, we get it. But look, it's a stable company that I feel I can invest into at any time. And I know that in 10 years from now, we'll be here. Even that they're facing right now. Let's be honest. J&J will be there.
Yeah.
I think, hopefully.
Yeah. And I'm sure people will make the same case for 3M, which is fine. Like, everyone's going to do what they're going to do. But the thing about Johnson & Johnson, you're so right. And some of the naysayers for Johnson & Johnson or dividend investing in general will say, yeah, but none of these companies are going to beat the market. Johnson & Johnson is not going to outperform the S&P. So what's the point of even owning it? Why wouldn't you just buy the S&P 500? And when I hear that, I think that's true. But then I think as dividend investors, keeping up with the market or beating the market is not the only benchmark for success. The beauty, I suppose, of being a dividend investor is there's this whole other thing that we're working towards that has nothing to do with beating the market. And at least personally, I think if I can grow my income, continue to grow my income, that's and someday be able to reach financial freedom doing that, or at least use that to pay a portion of my bills or sustain my lifestyle. It's like, that's the win right there. That's the ultimate trophy. I don't have to, I can beat the market 0 years out of 20, and I can still reach my primary objective. I can still get to where I'm trying to go, which is not something that a lot of people would probably agree with. But I think it is important to know that with this style of investing, sure, it's not fast. There's probably a lot of these companies won't beat the market, but there's more than one way to measure success. Like, what is it that you're really after? Are you trying to be the next Warren Buffett? Are you trying to be the highest echelon of investor, or are you just trying to like quit your job? Are you just trying to pay your bills? What are you really trying to do here?
I love that. And it's actually honestly where you started, right? You were talking about basically moving slowly through a process, because it's not about getting quick. It's not about, the gains immediately, this instantaneous gratification, which I really love about your channel, because I feel in that messaging, it's very same to mine. Like, it's not about getting rich by Tuesday. If you're looking for the next, 10x stock opportunity, you're probably on the wrong channel. But if you're looking over time to generate wealth, you can find it on Dividend Investors channels. Now, you mentioned a few minutes ago that you're looking for stocks. Now you have your top 3 right now: Procter & Gamble, Starbucks, Johnson & Johnson. I want to ask, when it comes to Ryne, what are you looking for in a stock? If you were to look for a new stock opportunity, because we do have our, right, Procter & Gamble, Starbucks, and Johnson & Johnson. They're big names. They're out there. But if we go, on a little bit smaller of a scale here, if you're looking for a brand new position, what are some of the criteria that you're looking for in these companies?
Yeah, this is such a great question, man. And this is one of those things that has evolved over time, and likely will continue to evolve as time goes on. And let me just add a disclaimer too. Like, I started doing all this stuff with 0 experience. I had no idea about investing. Everything that I've learned up to this point has been self-taught or with the help of others in the community. And so I'm not some financial guru. I'm not someone I don't have a finance degree or a PhD. I'm someone who's just trying to figure it out as he goes. And with that said, what I'm looking for now, first and foremost, is something that I can understand. Can I wrap my head around what this business even does? How do they make their money? So familiarity and understanding is a big thing for me. Number 2 are looking at the financials. Are they growing, or at least staying steady? Is their revenue increasing over time? Is their gross profit margin at least staying steady, staying pretty consistent, or is it increasing over time? Are they generating steady free cash flow enough to cover the dividend, and sustain dividend growth with that? Are they able to service their debt? Do they even have any debt at all? And I will say, is at least lately, companies that I've been looking at, I really, just for the sake of simplicity, have been loving no debt companies with zero net debt or negative net debt. It makes me feel that's really a swan stock, a really sleep well at night stock. They're not going to go bankrupt if they don't have any debt. Right. So those are a few just very high level things that I look for. In addition to that, I mean, I have a few high yielders in my portfolio. I wouldn't say yield is something that I even consider. Maybe that was a mistake that I made early on, is thinking that a certain yield was important. So that's not really something that I look for anymore. I do, however, these days, because I do already have some high yielders in my portfolio, I do look for something that will offer dividend growth. And I'm looking maybe 8% as a minimum. 8% and above is something that maybe even 7%, but something along those lines, something that's going to, offer increased income as the years go on. That's certainly something that I look for. But I would say that those are a few very basic things that I look for when analyzing a new company or doing research on a new company. So that's pretty much it. In a nutshell, do I understand it? Are they growing financially? Is the dividend safe?
Man, I have so many more questions. Every time you share insights, I'm like, questions, right?
A lot of those questions are probably, what is he talking about? Is he even speaking English? Who is this clown?
Question marks.
But right.
So when you were sharing about yield and yield chasing and how you perhaps made that mistake before, do you have a certain range now that you stick to? Like, or does it not matter? Like if you take like a, I don't know, like a waste management, I think, where's their yield at? Like 1 point something. Would that be a stock that would be in the Ryne Williams portfolio, or is that too low of a yield? Do you have a range that you do?
That's such a great question, man. And this is something that I kind of go back and forth on it when I think about it. I would say it depends. It depends on the growth rate. If I'm looking at a company that has a really low yield, but has a substantial dividend growth rate, so they're increasing that dividend at a pretty aggressive clip, that's fine with me. I know over time, over the next 20 years or so, if they're able to keep up that dividend growth, my yield on cost will look pretty nice with a low starting yield. We've seen investors be rewarded very heavily from companies that have those sort of stats. I mean, look at on a total return basis, of course, not just with dividends, but look at something like a Microsoft or an Apple. Never been really high yielders there, but it's worked out for investors. And I also think dividend growth is indicative of consistent and sustainable dividend growth is indicative, or I guess reflective of the company's overall financial growth. So that is why it is something I consider. But as far as kind of a threshold for yield, not really. I can't say I get super excited about something below 2%, but if there's dividend growth attached to that, then I would be okay with it. Short answer, no, not really. So once again, man, I'm pretty long-winded, so I apologize.
Oh no, it's good because it's all insightful. There's just so many investors out there. Yeah, you probably get it on your channel from time to time, or if not video to video, right? Like, oh, that's so low of a yield at 1.8 or 2.5. Why would you ever invest in that company? For me, it's the same exact answer. And it's like it's not always about the 9%, 10% dividend yield that might be cut in a month. That it's a bait and switch type of dividend yield. I want to go back to this other question I had for you before I forget here. So for those of you who don't know, Ryne, as he just shared, is self-learned dividend investor out there, learned from the University of Hard Knocks. But he told, I do follow Ryne on social media, and he is always reading. I've never seen a story of his with a book not in it. And so I want to ask you now, for your 3 to 4 years you've been investing, have you had one or two books that have just like wowed you? And if there is a book out there, and I have a feeling it's going to be a Warren Buffett read, but what book, and he's got it right here, I love it. What book do we have, and what peaks of insights could you just give us to that book?
So give me 1 second. I'm grabbing a few options here.
I feel like we should put, on as we wait.
Oh yeah, here we go. There's this one. And then let me get.
It's like all the university.
Okay. Yeah. So, okay. I've got a few good books, and these are pretty easy reads as well. I have The Intelligent Investor, which is an investing classic, but it's pretty dense. So I certainly would not recommend that for someone who's looking to get into reading about investing. First and foremost, a must-have is Warren Buffett in the Interpretation of Financial Statements. Hopefully you guys can see it here. Need to get this book. Really easy read. It teaches you the ins and the outs of financial statements and how Warren Buffett might look at them and what he looks for. But it'll take you line item by line item through all the financial statements: income statement, balance sheet, statement of cash flow. From the same author is The Tao of Warren Buffett, which is just basically a collection of quotes that he has, and it kind of explains them a little bit in depth. Once again, a very easy read. With both of those, I'll just read a chapter every single morning, and a chapter is like a page or two, so very, very quick. One Up on Wall Street by Peter Lynch, another classic, another easy read. I'd highly recommend this one. It's a little bit dry at times, but still an important read. I just finished reading this one, The Education of a Value Investor by Guy Spear. Really enjoyed this book. And I think I honestly probably finished it in like 3 days. It's pretty short as well, and a very easy read. And then I actually have two more that I need to grab that I'm just now remembering. But this one, guys, you'll love this book. Buffett, The Making of an American Capitalist. It's one of his biographies by Roger Lowenstein. I could not recommend this book enough. It's a really enjoyable read, and I think it'll really get you guys stoked about being an investor. There's two other books that I don't know how close they are. Actually, three. Sorry. So
No, for the merrier. This is better.
These are yeah, this is it. So, and I apologize. You guys probably saw me in my sweats. Definitely not attractive. But non-consensus investing. I got to thank my man Russ for this one. This is by Rupal J. Bansali. Hopefully I pronounced that right. But it's a really good insights on being a better investor and what to look for and how to think about the stocks that you're investing in. Definitely recommend that one. I haven't read this one yet, but it's next on my list. Fantastic Moats and Where to Find Them. From what I've heard, it's a pretty good read. It looks like a pretty easy book to read as well, but it probably just teaches you about all the different competitive advantages with the businesses that you're looking at. Lastly, Richer, Wiser, Happier by William Green. It's basically a collection of interviews that the author did with like all the greatest super investors, from Charlie Munger, Monish Pabrai, Guy Spear, Nick Sleep, tons of other great people in here. I don't know all of them, or I can't remember all of them, but highly recommend this book. So sorry, so many good ones.
Yeah, I mean, a wealth of knowledge here. Again, every time I see a story of yours, it's always with a book, a coffee, looks very relaxing. But most importantly, I'm like, man, there was in 2020, I did a book a week, and it was one of the most transformative years solely just because it was a book a week. And so much knowledge was being taken in. A lot of it was about, I wanted to understand the millionaire mindset. And I'm sure you could pick up that millionaire mindset from those books, the insights and the tidbits of knowledge. But those who are wealthy are always learning. They're always reading. They're not necessarily wealthy yet. They're well on the way to being wealthy, because the wealth is really coming from the wealth of knowledge that we're acquiring from the books. So I have to shout you out here and just say, like, you inspire me to continue on reading more. I'm, so many things in the air, juggling so many, jobs, YouTube, girlfriend, this, that, but it's all goes back to reading, right? And like the University of Hard Knocks, if there's someone that made an investing mistake out there before you, you don't have to make the same mistake. You pick it up in the book. You can go to Ryne's channel. You can learn about his mistakes, my mistakes. But the whole point is like, continue to learn, keep learning. And what I always see you doing, man, is just doing that. So I can really appreciate that. I want to ask, so you're always reading, and I know that from your stories, and now we really know it from all the books you shared. My man Ryne just got engaged not too long ago, so congrats there. Wishing
Thank you, man.
Many, many, many years of love and success, and a very, very happy marriage to be. I want to get a little bit deeper here into this relationship, if you don't mind. Are you ready for it?
Yeah, absolutely, man. I'm an open book.
So where do you guys stand, like, on a financial or investing, basis with each other? Is she just as into investing as you are? Does she let you just handle it? When you first met, was that a criteria for you that she had to have like her finances put together? Or like, what does that look like? Because I've had, the diplomats were on my channel. I've had a few other gentlemen on that we talked about how important it is to find a partner that is equally as fiscally responsible as you. And I'd love to know, like, how much has she played a role in your, in your reading and your learning and your investing? Do you guys partner up to invest together? Does she have her own portfolio?
Yeah, a lot of great questions in there. So I will say that we are pretty much on the same page financially. She's not as into investing as I am. I told her she should start her own channel talking about this stuff, because it would outpace anything I've ever done for sure. But she does have a little stock portfolio. She actually bought some stocks on Robinhood this morning. She puts in like $40 a week. And she's got VTI, she's got a little Target, some Starbucks. I don't think Johnson & Johnson's in there. She's got a few like individual holdings kind of like that, in addition to VTI, that she'll buy every single week. So she gets it. She understands the importance of doing this stuff. And like I said, we're pretty much on the same page financially. We have some pretty lofty goals and ambitions financially. And we both understand that to bring those to life, we have to be diligent about our finances. We have to be willing to make some sacrifices every now and again. And in general, we're pretty good about that. I think we have a really solid balance between being mindful of where we're spending money, but also allowing ourselves to, splurge a little bit here and there on just some minor things, nothing too crazy or out of hand. And this is something for both of us that's been a work in progress. When I first met my fiance, I don't even know how much I was into investing then. And so when when we first met, none of this stuff was on our radar. And as time has gone on, we've kind of grown into
this point, right?
What's that?
You weren't YouTubing at this point. This was like pre-YouTube.
Yeah.
Okay.
This was pre-YouTube. This would have been maybe 2018 or so, so maybe a couple years before I really started investing, 2018, 2019, somewhere in there. And so, yeah, we've kind of, our financial mindset and just our general mindset of what we want out of life has certainly grown together over the years, which is not an easy thing for some people, but definitely an important thing to be on the same page. And like I said, we both understand that to do what we want to do and be where we want to be, then we can't just spend money willy-nilly. We have to keep an eye on this. But it honestly, it comes very naturally, because just like me, she's very into health and fitness. She's very into working out. And there's a lot of the same principles that can be applied to that. So it's not, it wasn't a very easy, or it wasn't a very hard thing to get a grip on, I think.
Sure. How do you know when it's like being too frugal, too frugal, right? Like,
yeah,
draw all those lines. I'll be like, my girlfriend and I just went to Paris, and before the trip, it's like, first of all, it was her birthday, so I wanted to go to Paris. She wanted to go to Paris, Disney, and man, I looked at the flight prices and I was like they were the radar, right? Like, that was a purchase where I was like, I know it's gonna sting a little bit, but then when I looked at her face, right, this big smile, I was like, but I have to. And I feel like there's so many times when in different relationships, right, when it comes to money, first of all, there's always going to be, I think, uncomfortable conversations to be had. So to align with a partner is the most important thing. And I don't think it's as talked about on these financial talks, but like a partner who is on the same page with you financially is so paramount. The moment that made me the most comfortable was when she actually looked at me and she was like, if it's really too expensive right now, we could just push this trip off, for a couple months and we'll go then. And for me, it was like, no way. Like, I just saw how much it made her smile. But I do feel like there would be people who would just cut the line there and be like, yeah, you're right. Let's just go another time. How do you know when being too frugal is too frugal?
Oh gosh. That's such a hard question to answer. Really good question, man. How do you know when being frugal is basically, how do you know when you're overdoing it? I just think there's give and take, man. Just like any other aspects to a relationship, there's got to be give and take. Where you might be okay just sitting in a room doing nothing but working and making YouTube videos and eating rice and beans, like where that might be fine for you, she might not be into that. And so that's where it becomes a little bit of a give and take. And I'm the same way. Like, we were talking about this. We went to Disneyland not too long ago either. And it was something we talked about too, kind of had a pretty similar conversation. Like, we're just going to be spending so much money to do it. And we went with her family, went with my in-laws. And so it was a really tough thing to, figure out whether we should go or whether we should not go. But going back to the question, how do you know if you're being too frugal? I don't know if there's, dude, I'm at a loss for words, as you can tell. I really don't know the right way to answer the question, but I don't know. I think you just have to have compromise. You have to, like, okay, there's going to be times where one person, where she, in this case, is going to have to understand we just can't do it right now. Financially, we just can't swing it. It's not a good idea. Whereas, and there's going to be times where that's the case, and there's going to be the opposite end of that where you're going to have to loosen up a little bit. You're going to have to be okay with spending money on that you will never get back in at the expense of being able to invest that money. You're just gonna have to suck it up sometimes and do it, because I don't know, we only have one life to live at the end of the day.
Yeah.
And if you can do these things while still not deviating from your existing investment schedule or plan, if you're able to still invest and go do things, if you're able to still invest and have the money to, let me rephrase this. If you're able to go out and do these things and still have the money to invest and not have it take away from that, then what's that?
Yeah, I feel like your fiance maybe has a cup by the door, like listening in.
Yeah.
But
yeah.
Later, man.
Yeah. But, if you're still able to live life and invest and have that balance, I think that's something that you should strive for. And it's so easy for us who live and breathe this stuff, it's so easy to look at every dollar that goes out and think of what it could be if you just invested it. But that's such a slippery slope. That's such a dangerous thing to fall into, I think, because if you're constantly thinking that way, you're never gonna have any real fun, any fun outside of investing, really, which is fun. But you're never going to have balance in life. And as they say, everything in moderation, even the good things. So, I don't know. To answer your question, I just think, I think, I think you'll have to, and it'll take trial and error, but I think you'll just have to know when to hold your ground on some of the financial things or stand your ground on some of the financial things, and know when to pick your battles, I suppose. Does that all make sense?
I love the answer. Because look, Jason Fieber and I were talking about this way back when he was on, and dude, he did a whole year worth of just eating ramen noodles. And first of all, that's awesome. Like, kudos, because I don't think you could do that, number one, with a girlfriend. It's like,
yeah,
third date, ramen noodles, fourth date, ramen, ramen all year round. But kudos to him for doing it. On the other end, to what you just shared, it's like, life is so short. And from an investor standpoint, I'm guilty of this, 100%. I will skimp out on, a dinner for myself. Like, when I'm with my girlfriend, all is fair game. I'll go out, I enjoy. But if it's just me, I will, skip the sandwich shop around the corner, or skip out sometimes on a good dinner just to treat myself, because I want to invest. And I think that $5 or $10 or, $20 is going to do me much better in the next 10 to 15 years, 20 years. That's how I look at money, at least at this point in my investing career. I don't know if it's necessarily healthy. There is a balance. I will say it doesn't happen all the time, but a lot of the times, right? I see you sometimes going to Starbucks, right? And I'm always joking with you, and I'm like, oh man, that's Starbucks dividend. But I feel like every investor needs to strike that balance that you're talking about, to really be able to live life and invest. To that end, what's your budget like? How much of your income is going into investing?
I'm so glad you asked that, because when you were talking about this, I was thinking, dude, budgeting could be the answer to a lot of people's problems with this stuff. Just knowing where money's going, that'll give you a sense of if too much is going to one particular place or not enough is going to this other place. So in terms of how much I invest as a percentage of my income, it varies, because just doing what I do, my income fluctuates, just being a full-time creator. It goes up and down. There's ebbs and flows to it, but every single week I try to invest $150. And as long as I can do that, I don't know, that's just kind of how I think about it. Right now I'm investing $150 every single week. As time goes on and my income hopefully grows, I'll increase that. But for now, I'll get to where I'm going someday if I can just keep fueling the fire, keep stoking the fire. So for now, that's good enough for me. And then as far as budgeting goes, you kind of mentioned going to Starbucks every once in a while, which I do. I'll go to Starbucks here and again, but
Drink
and
of
you'll
choice.
have people say,
I was just
what's
wondering
that?
about this drink of choice for like a frappe, mocha, choca. What's the
Yeah,
Starbucks go to?
dude. Oh, I just get coffee. I just get coffee with some cream and sweetener, nothing too crazy. And my lady gets a sweet cream cold brew. So she kind of dresses it up a little bit more. But it's not like we go to Starbucks every single day. That could be a problem.
Yeah.
That could be a problem. Going to depending on how much income you're generating, that could be a problem. And then that might be a conversation worth having. Hey, I think we need to cut back on Starbucks. But am I gonna sweat going to Starbucks once every 2 or 3 weeks? No, no, not at all. It's okay. You got to allow yourself to be able to do those things, or else you'll live like a complete hermit. And over time, you know, hey, stop it. Sorry, my cat back there. Over time, it could come as it could be a detriment to your relationship, and that's something you don't want.
Yeah. Well, I look again, like there are a lot of lessons learned, at least on my end, from way, way back in the day, early 20s me that was just investing gun ho, like everything needs to be in savings and investing, wanted to skimp out on all the dates, all the fun. And I think there's just, yeah, the budget, like to that end, like have your budget, set your budget. And if you have a part of that budget that's allocated towards going out, just stay within your means and enjoy when you go out. But this ultimately, now I want to head in a bit of a different direction here. When it comes to, you own real estate, correct? At this point, we were talking briefly about some real estate that you own. Would you recommend in terms of a passive income stream? Because right now, yeah, you're a creator, full time on YouTube, I believe, and maybe some other sites, or
Yeah.
just
YouTube, and then I have my email newsletter that I put out every week. So I'm able to monetize that some, which I'm looking to really go hard with. I love doing the newsletter. But yeah, it's those two things.
amazing, amazing. Okay, so you have some, at least from real estate, then now passive income coming in. Would you recommend real estate? I want to briefly talk about this because I feel like I just had someone on that was heavily invested in real estate. I had, here and there, I think I had the average Joe on who talked about having some real estate and selling out of it. It was way too much for him. What's your experience been with real estate and passive income?
Yeah. I've had a decent experience. I've only had some real estate. I've only been doing my real estate stuff for maybe a couple of years now. So, not I haven't been dividend investing too much longer that I've been had real estate. And I've had a pretty good experience so far. Have a duplex, which we're in the process of selling. I told you about that. And then I have a piece of land, which I actually didn't tell you. That's also cash flowing because people are using it right now to store equipment. So both of those things are cash flowing, bringing money in that from both of those, which is nice. And so I do enjoy that part of it. I've had, and I don't want to get into detail on this stuff, but I have had some things in real estate that just typical, a lot of the reasons people complain about real estate or don't want to get into real estate, you can think of whatever things. I've had to deal with some of those, and so I understand why some people might not want to invest in real estate. And this, you just you just need to figure out what you want as an investor. How hands-on do you want to be, or hands-off? How much time do you want to be spending in it? You're going to probably be spending more time investing in real estate than you would if you just invested in dividend ETFs. I think real estate's great. I think it's a tried and true way to invest. So many people have made a lot of money investing in real estate. But do I think it's an absolute necessity? Not necessarily. I think investing in stocks, especially these days, is so much more accessible for someone just getting into this stuff. That I don't know. I just think it's so easy to invest in stocks. So much easier to invest in stocks over real estate. And I guess having said all of this, there's pros and cons to both, right? There's certainly trade-offs between the two, but overall, would I recommend real estate? I'd recommend learning more about it. At least I'd recommend learning more about it, at least maybe reading some books, watching some YouTube videos, a lot of great real estate channels, and just seeing what sounds good to you and just trying. we're all trying to figure it out as we go. And it's just so much trial and error with all of this stuff. So I'd recommend it if it sounds cool, but if you're like, nah, I think I know enough to know I don't want to get involved, I'll just stick with stocks.
Yeah.
Then that's fine too. Kind of like you, I know a few people that regularly watch my videos that have liquidated their entire real estate portfolio to put more into stocks, just because, like you said, it's easier, it's less stressful. But for some people, it's worth the stress. It's worth the downsides or potential downsides and risks that come with real estate. So
Sure.
it just varies from person to person, I suppose. And as I have said a couple of times, there's more than one way to skin the cat. The one thing I don't like, I will tell you, the one thing I do not like, and I feel like I've seen this so much lately, especially on Twitter. I feel that I see a lot of people talking down on the way that other people invest. I see a lot of people who are real estate investors. Maybe they have short-term rentals, maybe they're Airbnb. They've got this thing over here that works for them, and they're talking about people who are doing something a different way. They're talking about people who invest in dividend stocks and just saying all the downsides to investing in dividends. It's not tax efficient. It's slower. All the usual stuff. I don't like that. I don't like seeing other people talk bad about how other people investing, because there is more than one way to do things. And you have to find out what works for you.
No, I love that. Like, there's even across YouTube, again, like growth investors versus dividend investors. It's like, again, it's your scoreboard. Your scoreboard is your brokerage account. That's what works for you. Stay in your lane, do what is going to essentially yield you a return. And if you're
Yeah.
not confident in real estate, don't get into real estate. If you're not confident in growth, don't get into growth, right? Do what works for you. But you have REITs in your portfolio. I think you just released a video on one that I'm blanking on the name now of the REIT. It wasn't a Realty Income. It's really like a brand new REIT.
It may have been KRC, Kilroy Realty Corporation.
Yes. Do
Yeah.
you have, how many REITs are in your portfolio? And would you recommend over physical real estate?
I have 3 REITs in my portfolio. And I think if you're curious about real estate, but don't want to get into that, I think you can learn a lot about physical real estate by kind of learn a lot about it by investing in REITs. I think if you're interested in commercial real estate, a good place to start might be investing in Realty Income. So I definitely think there's some symmetry between the two. And I actually think that way about dividend investing in general before going into real estate. If you're looking to create some cash flow, you can really learn a lot about passive income and cash flow by doing it this slower, easier, more accessible way, dividend investing, than just jumping right into real estate. And the good thing is it's so liquid. If you ever wanted to, this portfolio you could always sell out of and use that to fund your down payment if you wanted to buy a rental property or something along those lines. That's the beauty of it. But as far as what I recommend REITs, was that your question, over physical real estate? Yeah, once again, man, it just depends. It so just depends. But dude, it's so hard to say that one over the other, because there are pros to each, there are risks to each, and so you need to weigh both sides and see what makes sense for you. And that could change over time too. What you want now might not be what you want 10 years down the road, which is why, like both of us have said, we've seen some real estate investors sell out and go more into stocks. And there's been the other side of that too, where some have sold their entire portfolio to go into real estate. So different ways to skin the cat, man.
Sure. I'll ask you now the cliche follow-up question here, as we're just about done with the interview coming up. Looking back on your investment career thus far, what would be something that perhaps you made a mistake on or a regret? What would be something you've done, that looking back you would change, that X factor? Maybe it's your strategy, maybe it's a certain investment.
Yeah. So the one that comes to mind is when I first got serious about investing, 25, 26 or whatever, however old I was. Like I mentioned, I'd had a portfolio already just from that custodian account. And in that portfolio were a lot of growth stocks. Like I had Berkshire Hathaway, I had CRISPR Therapeutics, which I did really well on. I had basically a little portfolio going already. One of those holdings was SCHD, and I had a pretty nice position, or at least for me at the time. I had like 30 shares at a really nice cost basis. I think maybe in the 40s or 50s, and potentially even lower. And I end up selling out of that for just whatever individual stocks I own. I guess if I could go back in time, I probably would have sold everything else, but just held on to that one SCHD position and kind of used that as kind of the foundation for everything else, especially considering like a couple of years down the road, I ended up buying back into SCHD and building up a position in that. And so fortunately, I've built up a position that's bigger than what I had before, but still it would have been nice to have that, you know? So that's one thing that I probably would have done differently. There's probably some other things as well, nothing that really comes to mind, but you know, the things that I would change, as they say, this is also a cliche. You know, it's been a learning experience. It's brought me to where I am now. And there's going to be other things along the way that I'm sure I won't do right, or that I would probably will look back on and wish I'd done differently. But that's just, you know, you can't dwell too much on those things. You just learn from them. So that's kind of how I'm trying to look at all of that.
Sure. So tomorrow, as you know, is CPI day. We're going to get the new latest inflationary reading. I think there's an expectation out there across economists that the inflation will come in at 3.3%. Last week, we had the jobs report come out, the non-farm payrolls came in at 187,000 jobs added to the U.S. economy versus the expected, what we were supposed to get 200,000. So we do see a cooling in the economy. Inflation may peak up a little bit tomorrow, maybe not. We'll see what happens with the inflationary reading. But nonetheless, we do have a quite hawkish of a Federal Reserve who's still talking about hiking interest rates. And as you know, I'm a huge, fan of macros matter, even though Peter Lynch says it best, that you could spend all year studying economics and only about 1 minute of it would matter, right? But when it comes to economics and the remainder of the year here, what does it look like in Ryne's, lens? What do you foresee coming down the pipe, and how are you strategizing for the remainder of 2023?
Yeah, it's an impossible thing to predict, right? And even if you look at the macro stuff, I think a lot of us, one of the big questions hanging over our heads over these last couple of years is, will we have a soft landing, or will we have a hard landing, or will we not? And I think a lot of people thought it's kind of looking like now things were kind of having a soft landing. Things are looking pretty okay. Whereas maybe a lot of us thought that the sky was going to fall, and maybe it will at some point too. Maybe it still will. We just don't know. And so as far as my outlook for the rest of the year, gosh, man, I don't know. I really just don't know what's going to happen. All I can do is, what's that?
That's the wisest thing you could say, by the way. I have no idea,
Yeah, I really I can't find the words to answer that. And so all I can do is focus on what I can control, which is the research that I'm doing into individual companies, the amount that I'm contributing to my portfolio. And I'm just going to focus on that, just trying to become a better investor, do the best that I can, keep funding this thing, and keep trying to deploy that capital into, companies that will hopefully continue to bear fruit over the years, be fruitful for me. So that's really all I'm trying to do this year, the rest of this year, and all of the years that follow. And but with that said, just talking about the macro stuff in general, one question that you like to ask is like, do you think it's important, or do you think it is kind of a waste of time? And I think in the short term, it matters. I think in the short term, it can tell you a lot of that stuff can maybe tell you which sectors are going to be good to look at or bad to look at. I do think it kind of gives you some indication of what might happen in the near future, but I don't think that those over a long term that will, unless it's something extremely drastic. Sure. I don't think that a lot of that stuff will affect these companies over the long term, but it could create some good buying opportunities in the short term. So that's kind of how you would use that as a tool, I think. Would you agree with that, or do you think about it a little bit differently?
No, 100%. That's precisely why I think the macros matter, because that, I think when I say that, oftentimes people think I'm saying time the market. And I'm not about timing the market. I am about having time in the market. However, I do think there is wisdom when you're an investor taking a look at least from a macro standpoint, what's happening. So you can begin to focus yourself in certain sectors or with certain stocks. So for example, like right now, or the past 2 weeks, right, when Apple's a major position in my portfolio, when it was running up, I'm not really going to be looking into tech and Apple right now. But on the flip side, right, I started to look into utilities, right, and what people were selling out of. And then I was trying my best to then look ahead, right, into, again, the macros, where we are right now, the Federal Reserve, if they do hike interest rates, what would happen in that type of environment? How would businesses be pressurized? Would they be pressurized, right? In that scenario, I do think we may see a sell-off come the end of the year. I'm not talking about a recessionary sell-off, right? Maybe it won't be, but I am sharing that there could be volatility. So for me, I'm going to start to look into what people are selling out of right now, because I am a long-term investor. So now those utility stocks, right, or even, Lockheed, I was very interested in as of recently. I'm going to hold on to those babies for 10, 20 years. So I want to make sure that I am buying them when they're at their lows, when people are selling. And honestly, another, key for me is trying to find what insiders are buying and selling out of. Because what I realized was, right, when you take a look at the macro environment, what's happening, you do see insider movement and, selling out of certain positions. And then it correlates with this economic backdrop that I typically try to paint. I'm not saying, right, I could be wrong. It's really anybody's guess what's going to happen. You said it best. Like, we don't know. But I think it's important to try our best. And Peter Lynch even, shared that he did take a more macro stance and incorporate some economics there, but fully knowing that it's totally unpredictable.
Yeah, that's kind of that's the challenging thing about investing, is not knowing the future, but that's also kind of the fun thing. And I think why I like being an individual stock investor. Your portfolios are kind of an extension of you and the way that you think about the world and what's happening in it and what's going to happen in it. And so I think that's, a lot of people would disagree, and that's why they invest in ETFs and invest more passively. But for those of us who choose to buy individual stocks, like that uncertainty and thinking about all this stuff and how all these dots connect, that's where the fun is.
Yeah.
And being able to find potentially misplaced opportunities when there is certain sell-offs and a sell-off in certain sectors, knowing when the sell-off is justified or when it's maybe not, and knowing when to buy based on that. And that's actually, I grabbed this book a moment ago, this non-consensus investing. That's what this entire book is about. The subtitle is Being Right When Everyone Else Is Wrong. When there is a sell-off, when there are these fears in the market, as Warren Buffett said, be greedy when others are fearful. But, you have to know, and this is something that comes with experience, you have to know when that fear is justified or when that fear is overhyped. And that's going to be, your analysis on that is going to be different. It's going to differ from person to person. But that's where the fun is as an investor, is trying to think about this and make decisions based on what you think about all this stuff going on, whether it's macro or micro. And the two do go hand in hand, as you were kind of saying. If there are certain macro things going on, fears of a recession or interest rates going up, that's going to affect how people spend money and where they spend their money. And that's going to, in the short term, have an impact on the revenue generated by these businesses that we invest in. And so you can kind of connect the dots from there. But to say it's completely irrelevant is, I don't think that's right. But to also like spend hours and hours and hours and hours dwelling on it, maybe that's too much. So there's got to be some in between.
The balance, once again. How do you grapple with fear? Like personally, like when you're investing, because we've had a volatile 2-3 years, and of course we've been ebbing and flowing since. We still are, today we might even go into, again, this economic downturn. Some economists predict so, some don't. how do you grapple with it, and what words of wisdom can you relate to perhaps a beginner investor or even more experienced investor about fear?
Sure. That's a great question. So in the face of fear, there's really things when it comes to your portfolio, there's really three things you can do. You can either, if we're looking at an individual holding, you can either buy more if it goes down, you can either hold or you can sell. And I've done all three. I'll give you a few examples. I just sold out of 3M because I was afraid. I was afraid that what's going on with the company, they could potentially cut their dividend. I could be right about that. I could be wrong. Time's going to tell. But I was afraid enough to the point where I decided I no longer wanted to have it in my portfolio. I don't know if this is the right or wrong move yet. I don't know. Another example, Intel. I'm afraid that this company who's in the middle of a big turnaround, I'm afraid that the turnaround might not play out, but I'm not afraid enough. And I've seen my position down more than 40%. That's big for me. And that's something that's scary, but I'm not afraid enough to sell. I still have faith and conviction that the company will, over the long term, a number of years, be headed in a better direction and things will work out in my favor. So I have fear, but I'm still hanging in there. But then on the another example, Kilroy Realty Corporation. Another thing I bought into that company, and it's an office REIT. So as you know, offices are pretty out of favor. There's been many concerns that offices are dead. People are going to be working from home forever. When I bought into the company, I saw it just start to tank based on those fears. And I was afraid of that myself. Did I do something wrong in my analysis? Was I looking at this the wrong way? Is everyone right? And offices really are dead? Or is this overhyped? These are thoughts that I continue to grapple with, and time will tell. But in the face of fear, in that instance, I bought more. I watched the share price go from mid 40s when I bought it down to the upper 20s. And I bought all the way down. And it worked out for me in that instance because as it was going down and I was buying more, my average cost per share lowered from the mid 40s down to now the mid 30s. And what happened is that company was so oversold, and it seems like the sentiment surrounding offices is slowly starting to change, that the share price went back up to a place that is now above my average cost per share. So it ended up working out. And so I guess when it comes to fear, you never really know, but you have to make a decision one way or another, whether you're going to stay in or whether you're going to get out. And that's going to differ from stock to stock, as it should. You also shouldn't necessarily let, just because I bought all the way down with KRC and it ended up working, doesn't mean that strategy is going to work in the future for any other company that I'm taking a loss on. So you have to know when to make those certain moves based on, I guess, your thorough analysis of the company that you're looking at. And you might be afraid of what's going to happen because you don't know, but hopefully your analysis will tell you what the right answer is, or what you think the right answer is. And it's a little bit instinctual too. You have to go with that.
Sure. Wow. So many insights, man. But before I ask my last question for you, because you just, again, like every time you're speaking, more insights are coming my way. And I'm like, questions. I'm thinking back though, you mentioned a bit of time ago that you and your fiance have big plans. And I want to take it back on the personal front here, because we're going to end on an investment question. Go back personally. What are some of those big plans? What can we expect next from Ryne Williams and the path that you're trekking down? I'm so curious to know. I'm so sure there's so many of us that are curious to know like where you're heading, the plans that you have in mind. Because I mean, look, from at least where I sit and from how I see your channel and your growth and your wisdom over time, I mean, it has been beautiful. It has been an inspiration. I'm curious to know, I'm sure there's a lot of others out there who are curious to know what some of those plans are. If you can share anything, on the what's next agenda for Ryne Williams.
I mean, I probably overhyped it a little bit. It's just normal people stuff. We want to buy a house. We've been renting, and we're renting. And so we want to buy a house. That's kind of the next frontier. And we've talked about when we do that, and that's going to be like at least a year out, to be honest. But we talked about when doing that, we've thrown around the idea of just trying to pay off our mortgage as quick as possible to then use that money, or just basically have more money, not have to worry about that overhead. And because, you know, like financial freedom is where your income is, passive income is greater than your expenses. Well, housing's a huge expense. So if we can eliminate that completely, then it's just going to make it so much easier to reach financial freedom, not just for myself, but both of us. And if not that, it's still going to make life so much easier. Have more, or be able to hold on to more money at the end of the day. That could be more money to, you know, have more experiences together or invest more, and which likely would be the case, or maybe a little bit between the two. But that's the big thing. That's the big next thing, is buying a house, hopefully paying it off as quick as we can. And then from there, I just think it's going to open up so many more opportunities to do whatever, to invest more, whether it's stocks, real estate, to have more experiences, like I said, or likely a combination of the two. And all of that, honestly, just all of that is an attempt to just keep doing what I'm doing. I love being a full-time creator. I love making these videos and being able to be a part of this incredible community of investors. It's a dream that I never, it's a dream that's been brought to life. And it's also a dream that I never thought I'd have up until a few years ago. If you would have told me 5 years ago that I'd be as into this stuff as I am, and I'd be talking about it to the world, I would have thought you were probably on drugs or something. I never would have seen this for myself, but I love it. And so I just want to keep doing it. But like I said earlier, there's so many ebbs and flows. There's a lot of ups and downs with it. And so being able to not have that huge living expense would be a huge help, just to continue doing this. And so that's really, in the grand scheme of things, that's the big plan, is just hopefully be able to buy a house and pay it off and kind of go from there. So
I love it, man. Thank you for sharing that, you know, with us. And truly an inspiration, man. Every single video that you're pumping out with a lot of insights for us. Joining me here today, now for this interview, I mean, just plenty of insights, dimes that we're picking up as investors. Now, my last question for you, Ryne. I got $10,000 for you virtually. Now, if I were to give you $10,000 right now, you could not invest that 10 grand into an ETF or an index, just an individual stock. What stock would it be and why?
Gosh, man. So is there a minimum holding period with this, or it's like, no, what, $10,000 forever?
10,000.
Can't.
If you want, you could sell out of it next amount of time. That just gives us leeway into perhaps what you think may happen or where a stock may be heading. Yeah, anything.
Sure. Well, dude, God, man, I'm gonna say Starbucks. I was hesitant to say Procter and Gamble, and that's a very safe answer, I think. But you know, I'm gonna go with Starbucks. I think that just in terms of growth, I think the company still has a lot of growth in it. I also think it's for being a discretionary company, I also think it's a really stable and steady stock. You know, as a somewhat frequent Starbucks customer, dude, that place is never empty. The drive-through is always busy. There's so much demand for this company, and that demand just continues to grow. And long story short, I don't see Starbucks going anywhere anytime soon. Excuse me. And I think the company will just continue to grow. And so if I had $10,000 right now, that's probably where I would put it.
You heard it here first. Investors, again, we got Ryne Williams with us here today on the channel. Ryne, I want to go ahead.
Wait, I wanted to ask you, man, and I'm so sorry. I want to put it back on you because I am curious. Like, where would you put it? And you can't do an ETF, and you also can't do Johnson & Johnson. So
J&J, no.
Or Apple. No, you could do Apple, but no J&J.
I actually, who was it that asked that they flipped the script on me as well? I think it was the diplomats. I'm pretty sure it was both the diplomats, and it was, I would go, and this might be contested. I feel like it would be, but I would go with Tyson right now. Tyson Foods.
Yes, that's a good one.
Tyson, because again, when I zoom out of those macros, what I'm looking at is a company that's been heavily impacted. Yeah, I'm going to say right now, terrible management. I mean, their leadership, not so hot right now. They've been in the negative news spotlight. However, I think when I'm really looking at, right, the nitty gritty of Tyson, what we're looking at are economic factors that are heavily impacting their earnings. And so the cost of feed has skyrocketed, the cost of transit off the charts. And so ultimately, and not to mention the consumer, all of us, right, as the market's been ebbing and flowing, and we've been expecting a recession, we've been cutting back and not buying, right, the expensive meats. So we've been seeing all of this, I think, hit Tyson pretty hard. But when I understand, right, like, again, do you understand the business? Yes. Number two, you have Tyson, which is the largest processor of beef, chicken, and pork, and the second largest, I think, exporter out of the United States. I mean, I don't think it's going to go anywhere anytime soon, at least not in the next decade. And if you look back at their history, you'll see this ebbing and flowing when we have these economic crises. So I'm not scared about it. I have actually a relatively large position in Tyson now. And as you know, Ryne, I work over at Tip Ranks, and I got quite a few of my colleagues that followed suit in my investment. So I hope I'm right about this.
Yeah.
But no, my dad actually threw money into Tyson as well. And it's a long-term hold for me. Their dividend yield is above, I think, 3.7%, if I'm not mistaken right now. But I think they're a good dividend payer. It's Tyson Foods. I don't think they're going anywhere. I think it's a matter of time and the turning of the tides when it comes to the economy. So I'm going Tyson.
Really solid dividend growth from that company too.
Are you invested in Tyson? Have you?
No, I've considered it. I've looked at it before, but I'm not invested in it. And it's also like kind of like you were saying, it's at a pretty attractive valuation right now. So I do think it is a good one to consider.
Yeah, heck yeah. So there you go, Tyson Foods and Starbucks. Ladies and gentlemen, investors, we have Ryne Williams with us here on the channel. Go check his channel out if you haven't already, although I'm sure you all have, because it's Ryne Williams. And I know I've been on his channel every single week, video to video, getting a lot of new economic insights from him, as well as stock ideas. So if you haven't been there, shoot over there. And of course, Ryne, I want to say thank you very much for joining me, dropping all the dimes, nickels with us here on the insights, the ins and outs of Ryne Williams, how you're investing, your strategy. Thank you so much for joining us. And investors, until next time, we will see you
guys
there.